All right, so hello, fools. It is 2 o'clock Eastern Time. I'm Deidre Woollard. I'm the editor over at Millionacres, which is the real estate investing arm of the Motley Fool. We always do our Millionacres Real Estate Hour on Tuesdays, and we have a special treat, as Emily said. I'm joined by Mark Hamilton here. He's the CEO and founder of Hamilton Zanze, a firm that acquires multifamily properties around the country. They work with accredited investors to provide opportunities that generate cash flow and achieve appreciation. So I'm really excited to talk to you about all things multifamily and crowdfunding today. But let's start off with a look back at 2020. Very odd year for residential real estate in general and for multifamily in particular. So what did you see?
A lot of dislocation, obviously, not so much in the capital markets. The capital markets became very much more accommodative. It's relatively straightforward to borrow right now at really attractive rates. Where we saw disruption was in household movement, and certainly, if we're all suspecting that there really and truly was an exodus from a lot of major gateway cities, it's true. It's borne out by the facts. So people were on the move. And I think with some cohorts, that was a move into suburban homeownership. With other cohorts, it was a move really from one part of the nation to a very different part of the nation. Our business was fairly stable, but a lot of the urban infill, A-plus vertical properties certainly had a lot of disruption in terms of their occupancy.
So let's talk about that. I know you're talking about big cities like New York and San Francisco that were really probably hardest hit by that. Do you feel that that's a temporary trend, or do you feel like maybe second half of this year, once we get more people vaccinated, is there going to be that move back?
I think cities exist for reasons, right? We love cities. We're social creatures. We like efficiency. We like the amenities and resources that cities offer us. They can be very efficient. But I think right now, in terms of the occupancy of a lot of apartment properties or multifamily properties in major cities, personally, I think the occupancy story might get worse before it gets better. I don't foresee the same level of movement of people relocating, but I do think that although vacancy, we're able to track levels of vacancy in really any metro, and we're able to track rent levels. What's much harder to track is delinquency, and you're going to have one delinquency number in Los Angeles, you're going to have a different delinquency number in New York City. You're going to have a different delinquency number in Portland. And because there's effectively a nationwide moratorium on evictions, landlords have no opportunity really to force the issue with residents. And so, as we get better, as we recover societally and recover in terms of our health, we should regain the opportunity as an industry to recover possession of units where there are people who are not paying, and that will arguably inject at least a modest increase of vacancy. And so I think this is a year of sorting. I think 2021 will be a year of sorting out. I think 22, 23, 24 will be a year of building back. And I do think that cohort that drove urban apartment occupancy over the last 10 years, that cohort, those specific people have maybe moved, but the next generation will come in, and I do foresee them going back into cities. And so, it's going to differ depending on the city, but I think in San Francisco, which is where I live, I think it'll be a years-long process. If the summit is getting back to the fourth quarter of 2019 in terms of performance, I think it'll be a years-long process of that recovery.
Interesting. Do you feel that it is absolutely tied to the work from home and the remote work thing? And are you sort of watching that trend as well as far as how it correlates to multifamily?
I think it definitely correlates to that for sure. And that's going to have a larger impact on urban office buildings. You know, a lot of the Class A plus stuff has got long leases, but I do think there'll be retrenchment in the office building sector. For the multifamily business, you know, we've never been, well, let's just say it's been a very long time since we were an urban operator. We're really much more of a suburban operator and ex-urban operator. And while we've seen vacancy spike in the coastal gateway cities and rents collapse, we haven't seen that in our own portfolio. You know, we've historically, you know, in Seattle, we're not in Seattle. That's King County. We're in Snohomish County. We're in Thurston County. We're in Pierce County, which are the suburbs. And that would generally be true of any city that we're in. In Denver, we're not in Cherry Creek. We're in the suburbs. And our delinquency numbers have been digestible. We've probably sustained only, I think I did the math yesterday, and based on what I'm getting from our asset managers, our delinquency is only up 0.7%. So the suburban thesis is a little bit different than the urban thesis, and I do think to come back to your question about work from home, part of the reason that the suburban has held up is because people are happy where they are and they can telecommute to work, right? They don't have to drive. They don't have to take the bus. They don't have to take public transportation. And so I think that work from home has arguably helped those of us who are second city or suburban operators. I think perhaps it's hurt urban landlords because with sky high rents, you know, if you can move to a suburb and still do your job and have a little more use of the outdoors, that sounds like a pretty good deal, and you're going to pay lower rent. So I do think that the urban phenomena has been damaged more by relocation, and I do think that the suburban market has perhaps even been helped by some amount of work from home.
Has it changed how you feel about the types of multifamily in general, thinking about larger buildings versus smaller garden style complexes? It seems like the multifamily ones with larger shared amenities and things like that are becoming less desirable. People are more interested in these smaller communities. Is that something that you're seeing?
I think you're spot on in terms of what in terms of what households want. You know, they want something that's more intimate. They definitely want something in terms of a home that's more insulated from the pandemic. If you've been living in an urban high rise and you know, you park your car in a garage, you ride the elevator up, you go to the lobby, you ride the elevator up again, you walk down a hallway. I think that spooks a lot of people. Certainly, it's gonna be the case with hotels as well. Whereas if you're in a property that you go right into your parking space, you walk across the garden, you open your front door, and you're done. I think that's very compelling, and I think that's both a safety element and an intimacy environment. It's, you know, it's a little bit more of an intimate living experience. And again, to come back to your point, work from home is in there, right? Work from home is in that equation. But I think I started out 1 million years ago, and the first property that I ever got my arms around was a duplex that my wife and I bought in what was then a pretty rough and tumble part of San Francisco. And it was so rugged that it made her mother cry.
Oh, wow.
Well, she still let me marry her daughter, but she was upset by the side of the thing. And over the years, we've purchased bigger properties. We've gone to more localities. And on our portfolio today, the average size of one of our properties is going to be about 225 units. So it's neither super big nor small, but they're almost all suburban. And they have the same amenities, right? They have the swimming pool, the fitness center, the clubhouse, and the like. But there's not as much, a lot of the amenities are outdoors. And in terms of the indoor amenities, it's a clubhouse, right? You go in, you go out, or you don't go in at all. You don't have to walk through the lobby. And so I think the interest, or the appetite in amenities is the same, but the biases in favor of suburban are probably a little stronger right now. I suspect that with home ownership, people are more interested in moving to Boise or Bend or Bozeman, Montana, or one thing or another. And that's a completely different lifestyle shift.
Right.
I think in terms of apartment households, I think it's really going to be governed more by the ability to avoid the commute and the ability to avoid having to mill around a lot of other people.
Yeah, I think that's an important point. I also wanted to ask you about Class A and Class B multifamily this year and last year, because I feel like last year there was a little bit of a pull away from Class A, which is your top tier luxury rentals, and more toward Class B, which are your still nice rentals, but not your top tier. Is that something that you're keeping an eye on as well?
An interesting question. Historically, we've viewed ourselves as a Class B plus operator, and I'll say a little more about that. We've generally avoided the Class A plus stuff because it's just so expensive. People, in our view,
Right.
investors will overpay to get that and accept smaller returns because they view those returns as being bulletproof. The pandemic turned that on its head. Those are the properties that ended up getting hurt the worst in terms of their scheduled income. But when we think of Class A or B or C, usually you're really talking about more than one thing. Certainly you're talking about location. If you're in Seattle, it's Seattle. If you're in the Bay Area, it's Palo Alto. If you're in San Diego, it's La Jolla, right? It's the blue chip communities. Those will be viewed as Class A or Class A plus communities. Another factor that goes into it certainly is amenities and scale, right? A bigger property is going to have more amenities, and vintage also goes into it. I think institutional investors over the last 10 years have flocked to the urban vertical stuff, and that's what we refer to as core real estate. We're a little more of a core plus or value add, which means we're looking for slightly better returns. And so we're not gonna join the feeding frenzy to buy something that can pay a 3% cash flow. And so I think the urban core stuff, just what we would call core apartment properties, certainly the ones that are located in urban centers are the ones that are really being hurt right now. If it's a core property in Orange County that's more of a suburban, it probably isn't suffering as much.
Interesting. So, in terms of these different types of properties with different types of amenities, are you seeing you're seeing more toward interest in suburban? So, I wanted to ask you also about 1031 exchanges, and right now, I know that that's come up with the new administration, and so there's some concern about 1031 exchanges becoming less of a perk for investors. Is that something that you're also taking a look at? I mean, it's obviously it's way too soon to know what's going to happen there, but it's been said that that's something that President Biden will be looking at.
We follow that very closely. And you're right. I do think that the reemergence of that in the public discussion owes to the fact that the new administration has said they're going to be looking at it. We've actually done not only do we do a lot of business that's relevant to that derives from that. We've also done a lot of research on it, and there are good academic papers on the subject in terms of why it's an important part of public policy. I think that discussion probably falls outside of the discussion that we're having today. But I do think you correctly point out that the reemergence of that as a talking point in the tax discussion, I think you're spot on with that. We historically, we've done a lot of that. We go back a very long way. From the origin of my activity in this business, which was 1985, to the origin of our company, which is Hamilton Zanze in 2001. We've always worked very closely with a lot of friends, family, colleagues, referrals, a lot of people who've had long careers in real estate and are just tired of dealing with it, right? Tired dealing with the phone calls and the vacancy and the repairs or another. And so a lot of those investors over the last 20 years have come to us. They're generally people that we know. And we have done quite literally many hundreds of 1031 exchanges with clients. It's probably 2,000 to 2,500 exchanges that we've done or assisted with. And we think it's in a very important part of public policy that's probably misunderstood. I think it's generally being merchandised right now as just a loophole. I do think it's a very important economic driver. There's data on that. There are academic papers on that. And in my personal opinion, it's also a very important driver of the tax base for cities, counties, states, because if you can sell an asset, right, and temporarily defer the payment of those capital gains taxes and reinvest it, that's a transaction that a city or a county or a state is likely to benefit from because of the transfer tax. Whereas if the 1031 goes away, you might not want to do it. I think if they were to throw the 1031 away altogether, cities and counties would be the big losers. And they're under plenty of strain right now. They rely on those transfer taxes. But I also think that the 1031, we have the data. It drives jobs. It encourages additional net investment. And what we've seen is that when people do a 1031, for most such investors, it's not an ad infinitum iteration. They will eventually expose those gains to taxation. But in the meantime, and in some, not only do they place those funds back into properties participating in the tax base, they also make additional investments to improve the assets. And it's definitely a jobs driver. It's a jobs driver and an economic driver. We'll have to see where it goes. I'm not going to lose any sleep over it. We're going to get what we're going to get. And what's been discussed is a strategy that would make it less easily used by people who are very high wage earners.
Interesting. So you mentioned you've been in the business since 1985, and that means you've seen a lot of interest rates, right? So and you probably have never seen interest rates like we have right now, where we've already hit, I think the Freddie Mac PMMS, we already hit one record this year so far. We had, I think, 14 last year. How is that impacting what you're doing in terms of acquiring, and what is the lending environment looking like for you right now?
Let me take the second one because it's easier. It's a very accommodative lending environment. The rates are down. Rates are down more than they've ever been. I mean, we've borrowed in the high twos, right, for long-term fixed rate debt. Generally, I suspect we would say that our borrowing range right now is somewhere between 2.75 to 3.25, but those are historic lows. We almost passed out a few years ago when we actually borrowed at like 3.06. We couldn't believe it. But it makes it easier. It makes it easier to underwrite income with interest rates where they are. And it definitely, these interest rates are definitely supportive of values. And I was reading something just this morning by a famous real estate economist whose name is Peter Linneman. And I mean, he just says, the next 7 years are going to be a golden era for real estate. It won't be that simple because there will be blood in the streets, right? There will be hotel operators or retail operators, office building operators who get hurt. But low interest rates solve some problems. They're also very conducive to value. And historically, inflation is not a one-edged sword. It's a two-edged sword, and it can drive income. But his point was that Linneman's point was that it's really going to drive values, and we're seeing that. So anybody that has assets, they're more valuable this January than they were last January because rates of return have compressed. We have a portfolio of approximately 90 communities. we're generally transactional with that. In any given year, we'll sell a few and buy a few more. We tend to be a net buyer. But so on the one hand, it's a little bit of a congratulations, I'm sorry phenomenon, because on the one hand, it makes what you have more valuable. But when you sell it and want to replace it, right, whether it's through a 1031 or otherwise, you're going to pay more for what you're buying. So it doesn't change things for us all that much, because our practice is, while we might buy $600 million of apartment buildings in any given year, we're really almost more of a spot market buyer. We're in 15 states, we're in 28 metropolitan markets, and we are constantly turning over rocks to find the things that can give us the returns, really stress tested for expenses as we know them. And so it doesn't hold us up all that much, but it does make it harder to be a buyer.
Interesting. So did 2020 change some of that idea of where you want to invest? It sounds like you have your target markets. You're pretty sure what those are. Are you shifting the weights a little bit? We've seen a lot of movement toward the Sun Belt states. That's something that a lot of different companies, some of the REITs we watch, are invested in that. We're also seeing some of the home builders concentrating more in the Carolinas and things like that. Is that something that's also a factor for you?
A bit, yeah. For example, Seattle right now. Seattle is very expensive. I mean, the returns are going to be low. You're going to be buying it either because it's a piece of the rock, right? You're going to buy it and keep it and feel that it makes you secure, or you're going to buy it and bank on appreciation. Appreciation is tricky to bank on, especially with interest rates this low. As interest rates go up, that won't help any sort of appreciation strategy. But a lot of the cities that have emerged recently as significant cities, whether it's Denver or Phoenix or Seattle, or Salt Lake City, it's very hard to buy in those markets right now because they're just so fully priced. We have been buying more in the Mid-Atlantic. Recently, we've purchased probably more property in Maryland and Virginia, and in the DC suburbs than any other market. However, we are in the process of buying 2 properties in Portland right now because we found Portland's a market where we've done well. We like it. We feel like we understand it, and we were offered two assets, one each from a different seller that we've worked with, that we were able to underwrite. So again, it really just comes back to turning over rocks. We're not afraid of secondary cities. We're not afraid of tertiary cities. Boise is a market that we like a lot. Fort Collins, Colorado Springs. And we just go about the business of having the conversations with people every day and looking at what they send to us and then pouncing on the ones that we want.
Yeah, Boise was on our list of top places for rental property investors in 2020. So that's one we've been watching a lot. I wanted to go back and talk a little bit about the aging of landlords, because I think that's something that we're seeing. There's this demographic shift. There's the great wealth transfer that's going on sort of overall, but that's happening in real estate too, where the average age, it seems, of landlords is going up. So is that something that you're seeing a lot?
Yeah. And, I am part of that crowd. As I mentioned earlier, historically, a lot of our clients have been people who have some decades of experience owning property on their own. And, for a lot of people, it just gets to a point where they just don't want to do it anymore, right? It's, for a long time, I've said that apartments are a strength in numbers and a pain in numbers business. And, the pain in numbers is that if it's 300 unit property, you got 300 doorknobs, you got 300 to 600 toilets, you got 300 kitchens, you've got a parking lot where people are coming and going. There's it's a full-time job. There's a lot of stuff that has to be tended to. With bigger properties, it's vastly beyond what anybody can do themselves, which is why you have site teams. But the strength in numbers part of it is that if you have 300 units, even though you only have maybe 30 days to 360 days of lease security, our experience has been that if you meet the market, you're going to stay full. Your income targeting, you may not get exactly what you want, we didn't have major shifts in our rents last year, although we did have more delinquency, right? And so, again, our experience has been, if you show up for work every day and have people who like the work and want to do the work, you're gonna deal with the headaches, because somebody has a job. Actually, many people at a property have a job to take care of the real estate, and to take care of the residents. And the reward is that if you have decent real estate or better, and you do your work, people will stay with you. And that's what we experienced in 2008, 9, and 10. That's what we experienced last year. But
Great,
yes,
thank you.
even so,
Yeah.
people still want to get it out of their hair. And that's where we come in.
Right. And so you work with accredited investors. And do you also work with institutional investors? Are you working with family offices, individuals? Who are your clients right now?
Historically, probably 75% of our capital has been private capital from accredited investors, including ourselves. My partners and I, senior staff and our families are our number one investor. We have more capital in the portfolio than any other single investor. And again, it's families, right? But still, we practice what we preach, and we're the number one investor. And so typically about 75% of our capital will come in that way. And it could come in from people doing 1031 exchanges. It might come in from people simply investing from taxable accounts and making investments. It very frequently comes in from retirement accounts. Probably another 10% of our investment capital comes from high net worth investors or family offices. We work with probably 6 to 10, maybe even more than that, probably 6 to 15 different families. And then the last 15% will come from institutional investors, many of them household names, because they're, they might be an insurance company, or a fund, or one thing or another.
Thank you. So as we wrap up, I know that your firm has some green initiatives. I want to talk to you a little bit about climate change, because I think that's something that you can't be a real estate investor and not think about climate change and the ways that it could change things going forward. So what's that looking like for you?
So I would just parse that into two questions. One of it's going to be about geography, and we're not invested. We don't have any assets that have significant sea level rise exposure. That doesn't go to the things that we're trying to do in terms of being good stewards, except we are stewards for investors money, and so we have to be careful about that. And again, as we're in second cities, not gateway cities, we're going to have less exposure to that kind of stuff. But in terms of actually being responsible business operators, every single one of our acquisitions will get an audit for telling us what the green initiatives are that we can run. And also, we don't build new. We've never developed. We will build facilities on our properties, but we've never built a new property. So it's not like we're going out and tearing up a field or tearing up a green belt and building an apartment community. We're taking things that already exist and then making them more efficient. And I would say probably 80 to 90% of our financing, we sign up for what they call the green product, right? Which means that we're going to have a mandate to spend a certain amount of money increasing energy efficiency, increasing the efficiency of water use and the like. And it's all kind of garden variety initiatives. It could be something that's as modest as retrofitting or redesigning the landscape watering system, the irrigation system, so you're using a lot less of it. In many locations, we install landscaping that allows us to detect if there's a storm coming, right? If there'll be rainfall. So that'll go into the calculus in terms of whether or not properties are getting watered. You'll have flow restriction on water fixtures. You'll have flow restrictions on toilets. You'll have a lot of those kind of things. And then you'll also have energy efficiency, and energy efficiency is going to be primarily light bulbs, sometimes light fixtures. They may be inside the individual units. They may be in your common areas, in your clubhouse, in your fitness center, one thing or another. And very frequently it'll be outdoor lighting. You know, it's the lighting on the parking lot. It's the lighting on the exterior of the units. And ultimately, when we borrow with these green loans, we sign up for a very specific program of things that we're going to do that are seen to be contributory to cleaner living, right? To greener living, and then we take care of the work.
Are you seeing a move away from the use of gas ovens, gas heat, gas stoves? Because one of the things I've seen is that in some cities, for new construction, they're saying, you know, electric only and things like that. Is that something that's come up for you?
Only if we're only going to have that issue or that element just based on what we're buying. You know, we'll buy things. We certainly purchase properties that have an all-electric kitchen. That was, you know, those were popular way before you came along. I mean, even when I was little, you know, you had the GE display at Disneyland with the kitchen of the future, right? So the all-electric kitchen is not necessarily a brand new phenomena. I think people, a lot of people really prefer cooking with gas. But I do think that on the newer product, when we buy newer product, it's much more commonly going to have electric appliances rather than gas. Water heaters, you're going to get them both ways. You might have a gas water heater, you might have an electric water heater. If we were building, we would be thinking more about what the appliances are.
Right. And are you seeing from the investor side, are you seeing people ask about that? Are people, is there, we've seen the trend for, you know, ESG and socially responsible investing. Are your investors also asking those questions about the units themselves?
Yeah, people want to know that. And I think they want it mostly as a reassurance. Not necessarily as something that's binary. Either you're doing it or I'm not. But they want to know that, you know, that our private capital investors definitely want to know that we're informed. That would be doing certain things. High net worth investors and family offices also are going to want to know that we're being informed and that we're doing the things that we can. And then with some institutional investors, they may have a mandate, right? They may not touch it unless it has a green emphasis. And, you know, for the most part, those considerations get resolved for us by our borrowing strategy.
And are you concerned about the overall aging of apartments in general? Certainly, we've seen it with the housing stock, right? The average houses keep getting older and older. There's not enough housing stock that's replacing existing stock. Is that also something that's happening on the multifamily side? Are you concerned about that the aging of the stock means that there's, you know, more repairs and things like that needed?
It's actually a very interesting question, and the answer is kind of counterintuitive. You know, as I said, you know, once upon a time, my wife and I brought a broken down duplex, and we bought. You know, we ended up buying a lot of stuff in San Francisco that was old. Then we started investing in Oakland, and we bought stuff that was not quite as old, but it was very routine for us to be buying something that was 40 or 50 or 60 years old. And properties do wear out. Let's be honest, right? And historically, there have been landlords who just won't spend money on their properties, right? They're going to squeeze every nickel out that they can in distributable income, and they're not necessarily going to put money back. Our approach has always been to put money into the properties and make them better. But what's happening right now that might really be a little more of a social or governmental concern is that that because so much of the apartment stock that's been built in the last 10 or 15 years has been what I would call the super A+ stuff, right?
Yes.
Build. It's got all the bells and whistles. The rents are going to make your eyes water, right? What's happening is that's created a marketplace for renovation, or I should say it's boosted the marketplace for renovation. And historically, as properties age, they become more affordable. It's what we would call affordable with a lowercase a rather than an uppercase a. You know, it's just affordable by default. That's its market premium. But what's happening is that a lot of the older stock housing stock from the 70s or 80s or maybe even the 90s right now. It's not being left to take the path of its natural life cycle and become more affordable. It's actually being renovated. And so when those are renovated, people will pay a higher rent. There's more of it. You get something more of a premium. And so, there's again been discussion not only in the industry, but from a standpoint of policy about what do we do to replenish that housing stock, which might otherwise become more affordable housing. Because nobody's building, if they're building the super A plus stuff, right? Nobody's building the B minus or C plus stuff. It's just not getting built. It can't. And so that's probably more of a concern in the industry right now is how to provide enough housing that's workforce housing.
Yeah, I know that that's also been discussed on the federal government level too, of how to do that, because it's a big problem in a lot of cities. I know, you're based in San Francisco. I feel like that conversation almost kind of started in San Francisco, where there's so many people, those super commuters that are, doing a 2-hour commute just so they have a place that they can afford to live in.
Yes.
Yeah, definitely.
But you would see that in any major metropolitan area. There are certainly a lot of cities in the Midwest that I don't know anything about. But in any metropolitan area with MSA, metropolitan statistical area of 250 to 350,000 people or more, is going to have that. It's going to have a need for more diversity in the housing stock. And right now there's less.
Yeah, that is very true. So as we wrap up, one last question. What is your sort of overall forecast for this year and coming into the next year for multifamily? And what would you tell investors who are maybe looking at some of the multifamily REITs or something like that? What should they be thinking about?
So it's a good year to be it's going to be a good year to be an owner, right? And we talked about that a little bit because values are full, right? Values are very full right now, and the financial markets and probably the Fed are not really that concerned about asset valuation bubbles. They're more concerned about people having paychecks. And so on the capital side, it's going to be very friendly to people who have assets. It's going to be more of a challenge to get into the market because pricing is high. On the operating side, again, you're going to have a tale of two cities. New York operators are going to have a lot of work to do. Suburban operators probably we don't have as much recovery that we have to accomplish. Again, our collections in 2020 were not really that down. Whereas if you're a New York City or a Boston or a Los Angeles landlord, you definitely had collection problems. The 1031, I think that'll get tossed around. Do we see something on that this year? It remains to be seen. But I actually believe, and I hope I don't have to eat my words at a later date. I believe that there's something of a reset right now. This is something of a reset year. Interest rates they're not going to go lower, right? And I've called that wrong for 30 years. So
can't rule anything out this year.
So be advised. I mean, I don't mind if they go down. I don't think they will. But in terms of operations, it's going to be. I do think that this is the trough, right? And if you're in suburban or secondary or tertiary cities, the trough isn't that far off from a peak. If you're a hardcore urban operator, you got a lot of work to do. But I think operations for all of us will firm up as the pandemic recedes. We all want that. We're all waiting for it. And I do think we're all, once we're all vaccinated, we will all slowly creep back to our old norms. That could take years. I do think you're going to see masks, right? Masks and, the handshake, the mask is on, the handshake may be gone, the hug may be gone. I don't know. but we're going to slowly, I believe we will slowly recover our old norms. And so it's a process of recovery from where we are now. Will we get back to in terms of a peak, will we get back to the peak of the fourth quarter of 2019? History tells us that we do. It's just like the stock market. The stock market got halved in 2008 or 2009, and then it took off again. So I do think we'll recover our norms. I think it's going to be, I think change and recovery is going to be incremental. And I think the adoption of the old lifestyles is going to come slowly.
Well, great. Thank you so much for your time today. This was a really great sort of look at multifamily in general.
Well, I'm honored and really gratified to have been invited, Deidre. Thank you so much.